if you talk to the big money, you talk to family offices where they're putting money, yeah, they'll put some money in the short-term rental over here, you know what I mean? But they're really chunking down into the multifamily.
Ladies and gentlemen, welcome to Real Estate Investor MBA. My name is Tejas Gosai, and I've had the honor of helping hundreds of investors achieve the American dream by creating generational wealth through real estate. I've spent the past few years interviewing the most knowledgeable experts I could find in the business to cut your learning time and conquer the hardest subjects in the game. Check out rei.mba, which my team and I have packed with over 75 interviews and free access to our real estate roadmap, webinars, and publications. If you're listening, I am rooting for you, and you're already on your way to financial freedom. Cheers and happy hunting. All right, we're here with Charles. I try to get the best guests on the program, as you've seen in the past few episodes. We're amping it up a bit. Charles, thank you for being here.
Thank you so much for having me on. It's great to be here.
For sure. We have a lot to get into. First, you're a very busy man. Can you bring us up to speed on how you got here? And definitely share the story of your growth. A lot of our listeners might have not invested in real estate yet, and I keep barking at them to do so. But welcome to the show. Let's hit it.
Sure. Yeah. So a couple minutes background on me is that I'm originally from a small town in Connecticut. Grew up in a real estate investing family. My dad was a multifamily investor. He started a few months after I was born in the mid 80s. That was my second education of going around with him. He self-managed properties. These were D class and C minus properties. So less ideal properties, ones that you probably don't want to be investing into, and difficult properties, difficult areas, difficult tenant base. Everything was difficult. And so as he started growing in his business, he started buying better properties. And when I got out of college in '06, I purchased my first multifamily property, which is now they call house hacking. But back then it was really just buying a property, multifamily property, living in one and renting out the others. And that's exactly what I did. It was a 3-family property. Purchased it. I rented out the other 2 floors. And then a couple of years later, at the beginning of '08, I did it again, or at the end of '08, I did it again, which is a much different time between the end of '06 and the end of '08.
For sure.
And then off to the race there. And in '09, there was a ton of commercial properties that came available because of everything that happened with GFC. In 2009, 2010, I purchased my first commercial property, which was a mixed use property. So like apartments on top, an office on the bottom, which you'd see in any kind of city center. It's a normal kind of configuration. And then grew from there. A couple of years later, I moved down to Florida in 2012, where I've been since. All those properties I put in charge of a third-party manager because I was self-managing myself for those 6 years.
Isn't that fun?
Uh, in the beginning, it was really overwhelming. And then little by little, I started doing some delegation, which I should have done delegation earlier. And it's like everybody says, right? No one's like, I delegated too early. It's always like, you brought on people too late, and which is fine. I mean, you learn your lessons. And now, when you talk to people that are newer, you tell them, listen, get someone to do all this stuff. And don't deal with this and get a bookkeeper and all this stuff that I hated doing, but I did. Have third-party property manager really kind of shed light on because my dad never had one before. So for all the decades that he was investing, he never had one. And so it was something that when I brought it on, it was much easier for me to focus more on what I was doing in my business, which was I had an online business, which was at this point my main source of, and then I was investing in real estate on the side. And it allowed me really to focus in my real estate business on really buying more properties. So once getting down to Florida, started looking and purchasing larger properties. And really a few years after that, so like 2018 or so, we've really been focused mainly on syndications and here in the Southeast. And so that's really where we are now. We're buying.
What kind of properties? Yeah. How big, asset class, all that fun.
Our box is really 1985 or newer, B-class properties, and a 100-unit plus. And I mean, that can change a little bit, but the main thing is the ability to have 2 on-site people without it like costing a ton. You know what I mean? Because if you go down too small, you can't have the people on site there. So it's really, let's just say 80, 90 or above really. But really when I would tell people it's 100 plus is really what we're focused on. And 1985 or newer, all the stuff I had been buying when I started, all that like it was like really old C class, and there was just like continual issues with it. We're out of all of our C class properties now. We're only in B class. We sold the last one a few months ago, and
congratulations, that's a big deal.
Yeah, thank you. Yeah, I mean, we sold 6 properties in the last year and a half. So mainly all C-class properties, but it was just something that It's harder when you're working with passive investors investing with you and dealing with C-class properties. They're a little bit more volatile, and the cash flow isn't always consistent because of the demographic of your renter base. You know what I mean? They don't have as much money. They don't have a savings. Everybody reads all the articles. 60 something percent of the people living paycheck to paycheck. And I read an article earlier this year, and it was like $400 is the average savings that a C-class resident has. So even if you're renting apartments for $900, or even if that's $1,000 and you're renting apartments for $1,000, I mean, any little disruption, they lose one day a week at work, and you're getting rent late. You know what I mean? Because they're not paying Netflix late;
Yeah.
they're paying you late.
You know what, though? That's great because not that many people look at it that way because
Yeah.
it's always like, I can jack the rents, I can do this, and they're going to be fine. But you're right, because what you're underwriting is the tenant.
Exactly.
And you got to step back for a second, though. You went
Mhm.
from these smaller units to these massive units. Was there a progression? And that was 2018 to like 20-ish?
Yeah, so just like dealing with still smaller multifamilies, once getting down into Florida, and small when I'm saying like right around like 10, 12 units and stuff like that we were working with. And then, our first syndication wasn't 100 plus units. It was 59 units. And it was actually, we did it in two sales purchases where we had purchased a 32 unit. And then we purchased a portfolio of, I guess, 27 units around it, which was all 3 and 4 unit properties.
Hmm.
So it was like a mismatch of a ton of work, but a mismatch of it. And we sold it all off. We thought we were going to sell it all off as one, but we sold it in 2021, and it was just hot to sell it as it was. So we sold off some off to some doctors and some off to another investment company, or dentist or something. So it was difficult doing that. And I wouldn't suggest the portfolio model, but it was something where we were able to get the units. It was very inexpensive. You know what I mean? It was like 60,000 or 50 something $1,000 a unit, put a few $1,000s into them, got all the new management in there, everything like that. And we were selling them for over 100,000, you know what I mean?
Wow.
A unit. So
It's brilliant. Where did you go from working with your own capital, your family stuff, to outside investors?
one thing about that is like my dad was, when I started investing, it was something that it was always kind of like an arm's length mentor. My dad never lent me any money for any of my properties, and he invests now with some of our properties. He's in like two or three of the ones that we're in now. But it was a turning point, was right around like 2017, when you would just be like tapped out and you start seeing deals still, you know what I mean? And it was just like that was something. And I was speaking to a mentor of mine, and he was like, the only way you're going to be able to do it is by raising capital. And
Yeah.
it was something that I like because I learned about syndication originally in 2008. Somebody sent me a book, and I was reading it, and I was like, "Oh my god, this is like terrifying." Ask
Yeah.
people for money and
Oh,
everything that goes with it, and it's like, "Oh my god, these are big amounts of money too. It's not like $1,000 bucks." You know what I mean?
yeah.
So I was like,
You
"No,
you
no,
you
no."
switch from that whole like, it's okay or whatnot to, oh my gosh, I have to look at myself in the mirror and all these people are relying me and it's millions of their dollars and they've earned it. And so you got to make the right decisions. I'm a fund manager. It's really tough.
Yeah,
People don't realize how difficult it is personally to
yeah.
take on the role, but continue.
Yeah, no, I definitely agree with that. I think it's more difficult to working with the investors than it really is working with the properties in most things, because in
I
the
agree.
properties, you have a set system. I'm getting a lease roll, I'm getting a rent roll every week of what we've done, what we do, and I can make decisions. Oh, we're not renting anything on apartments.com. We'll get rid of it, put the money over here, what we're doing here. And that's much easier. But then when you're dealing with someone, we just went through the whole COVID thing. We dealing with a lot of distributions being paused. You know what I mean? A lot of all that conversations. Those are very difficult conversations,
Yeah.
especially when people are like coming on board and telling you, very have in their mind that they're pretty much investing into some sort of annuity, right? That's one thing I like really hate about the whole syndication model, or most syndicators, is it's sold like that. And you're like, no, it's like we're going to send off excess cash flow. You know what I mean? Our goal is, it's going to start like 4% a year. Our goal is to get to 7 or 8% a year, but like it just doesn't always work. Like we're buying a business. You know what I mean?
It's nice of you to say it that way because I see all this marketing now that things have changed over the past few years. It's like, you're going to get this, you're going to get this. But they don't say that you have to fund the entire project and your money's going to sit for a long time. And you have a lot of those issues. How did you structure things? Did you build a fund per property? Did you build an overarching fund? How did you pull this off?
Yeah, so when I started our first ones we were doing, myself and like three other partners, we had put together a just a regular syndication per property. And It was much easier to raise for that. It was in Tampa, which was a growing market, same as it is today. It was much easier to get people on board. You know what I mean? And we were
Yeah.
raising like a couple $1,000,000. I think it was like 1.8 million, I think, for the first deal. It was a lot of money. It was the most money I've ever raised. And I mean, but that's one thing you learn about. It was my real first deal of working with partners that were not my brother. You know what I mean? So it was something that it was difficult because people are like, oh, everybody raises this amount, blah, blah. And I'm like, all right, I got mine all set. And mine was all set because I had people pretty much asking me for years to invest. And I had no idea how to do it. And it was like, you can't JV, you can't do this, you're going to get in trouble. So I was like, okay, I don't know how to do this. So like syndication, I had everybody lined up. And then my partners, there's two of my partners, their raises came in short. So like, all right, I'm back on the phones every day,
Yeah, yeah.
making up for everything. So it's like, it was a ton of work. It was a mess. You know what I mean?
I'm happy you're mentioning that too,
Yeah.
because a lot of people, I was a cold caller to get into the real
Oh,
estate business, and it was horrible. Like,
yeah.
but I eventually liked it, dealt with the objections and got really behind the product. And that was more of the sales. It wasn't really like, let me try to sell this. It's like, look, here's what I'm doing. Here's exactly how I'm doing it. And that's how you get to be as a fund manager. I get the same calls. It's like, hey, the world is blowing up.
Yeah.
What are you doing to make sure that my investment's okay? It's a 45-minute long conversation. You can't just dip a report or some P&Ls. People really want to hear that you are mitigating their risk, and it's not easy. I'm so happy you mentioned that. It is ebb and flow.
Yeah. It's difficult. Like you said, at that point, we were raising for first deal. So I didn't have anybody else I was managing investor wise. But it was something that now you have it and you're raising it, and then you're raising money from people, and then they're talking about investments they already have with you. It's a lot of work. It's a lot of work to keep everything going. But also, I mean, they've invested a lot of money with you. You told them what you're going to do, and you got to make sure that you do it. You know what I mean? And if something goes, astray, you really got to tell them immediately what's
Yeah,
happening.
absolutely. Prudency. It's like,
Yeah.
just be obnoxiously blunt, and it's fun to be regulated by the SEC, all that great stuff. But here, let's jump into the next part. So, who are your investors? Where are they located? Where are you specifically buying assets?
Yeah. So where we specifically buy assets is how our model is set up is that we work with three different operators and we cooperate with them, and they are boots on the ground in our markets, which is Dallas, Greater Atlanta, and then also down here in Florida, we'll work a little bit more alongside them, boots on the ground. Like Tampa's very difficult, but really Jacksonville, Orlando, Tampa, that whole what we call the I-4 corridor down here. And
Right.
those are the main places where we're buying property, and it allows us for our investors, gives them a little diversification of markets. Everybody, when you hear Florida, people say everybody's moving there, and then the next thing out of their word is hurricanes. You know what I mean?
Yeah,
So
yeah,
it's like, and people from Florida don't really, they're used to it, so it's not like a huge thing. But people outside of Florida, like, I want to touch the growth, but I don't want to like get involved with hurricanes, and but it's also like, so you can give diversification to your investors by offering deals in other parts of the country that are still growing, at the same clip as the Southeast. So our investor base is mainly professionals and entrepreneurs. I would say mostly entrepreneurs, or just
they're
they
accredited.
yeah, credit investors are mainly. Yeah. We do 506Cs mainly, and then we'll have like a 506B. It's maybe like one a year as we used to do it. Everything's slowed down
Let
this
me
year.
act. Let me act a little bit
Yeah.
different. So, what is a 506C? Why is it different than a 506B?
Sure. So the C is what's called for accredited investors only. So that's for a person that makes $200,000 a year and or with their spouse, like legal spouse, $300,000 a year for the last 2 years. And then, and or they are worth $1 million, not counting the equity in their home, which is usually the killer for a lot of people. And then the 506B is really for sophisticated investors that don't meet those other accredited investment standards. However, they do have knowledge of business or real estate, or they've been around business at some point. That's what's considered a sophisticated investor.
Yeah,
And
those are
yeah,
the two. That's pretty much it. That's the
yeah,
world of syndication. It's you're going to go this route or you're going to go this route, and then it's like 506C advertising, 506B no
exactly.
advertising.
Yep, that's the last thing I was going to say. Yeah, exactly. That's the two main things. So you see someone advertising something that's a 506C, or it should be, and then if they're not, and it's like friends and family, 506B is really your country club type thing. You know what I mean?
Right.
So you see somebody out and you're asking them, you have a pre-existing relationship. Let's get into the SEC
Yeah,
terminology.
that's right. Well, it's neat to hear this because let me recall what you were just saying. You had people asking you to invest, and that's like the cream of the crop as a real estate guy who wants to do larger scale or build up. How did you get people to want to invest with you? And then, follow me to the path where you created the first vehicle to do it.
Yeah, so, after doing it for about 12 years, I was just like, real estate, I just feel is, it has to be, for me, it's the best investment vehicle. And multifamily is just my favorite. I just
Yeah,
feel I've seen
me
for
too.
many
Here,
decades.
here.
Yeah. And I understand there's all these other, there's so many other different kind of strategies out there. But when you get down to it, and if you talk to the big money, you talk to family offices where they're putting money, yeah, they'll put some money in the short term rental over here. You know what I mean? But they're really chunking down into the multifamily. And it's just what it is. There's no government regulations in the sense of I don't have to worry about, my town hall getting together tomorrow and shutting down my whole business, short-term rental hassle. You're owning these assets. People need more of them. We have such a lack of them. So no one's getting rid of them. They just want more of them. They just come to you. How can you make more of them? Well, it takes 3 years. I need all this other stuff. There's a huge demand for it. And then also when you're talking to people about that, it's just one of those things is that you'd get people that saw what you've done and they see the properties you've done. And, I had friends that would ask me about investing into them. And I was like, well, this is what you do. And I was like, just like explain to them to be active. And these people were never going to, and they never should have, you know what I mean? They're just like, you too busy, you know what I mean? And they're like, okay, they want the diversification. And they're like, oh, I'm a little scared. I want
Yeah, yeah,
diversification, but
yeah.
I don't want to
Totally.
get in there. So I was like, when I started getting involved and I passively invested, and then I was like, all right, this is how it works. I see exactly how this goes. And then when I did my first one, and you had partners that were working together, and we had all of our roles set up. That was one good thing we had. We had all our roles set up, and we had done, you vetted out your partners very well. And I was living only like a half hour from the property too. So I had all these boxes checked of keeping an eye on everything as it was going. And then I just had people that are like, they want to invest. And every person that said it did invest, which is very weird. It's not a normal thing for it. Then as we did additional deals, we did a deal like a year or so after that. And that one it was more of a normal one. You know what I mean? Where you had investors come in, they give you a soft commitment, and maybe 25% or so back out or change their
Yeah.
mind for whatever it was. So, all these different things are changing, but it's just one of those things is that people know what you're doing. And I can see how people on their first couple deals using social media, because I never used it back then. And I was just doing word of mouth, and how much powerful it would have been because they would have been following you. You know what I mean? And
Yep.
being like, I want to do what they're doing. I want to get involved with this. I'm interested in learning more at least. You know what I mean? Yeah, just telling everybody what you do. Some people will be interested in learning more.
Yeah. Which one did you go with first, though? 506B or C?
I did B.
Nice.
Yeah.
The right
Friends
way
and
to go.
family. Yeah.
Yeah. Bring me up to speed. So, like, now we're here. You are managing, you have your territories, you have investors. People are a little bit weary, so they need some conversations and then articles, exhibits, information on how things are going. So, what are you doing right now? Are you still buying? Are you, afraid of rates? Where are you at?
I kind of sat on my hands in the early 2010s, just kind of seeing where everything was going and then jump back in. And that was not the worst thing I've ever done in my life, but that was something that I kind of changed my mindset with a mentor of mine that was like, you should always be buying, you should always be looking. So that's exactly kind of what my mentality is always looking at deals. People send me deals. I'm going to review them with our group here and see what we want to do. Many of them are all the ones that we found over the last 3 or 4 months, we've all turned down. And
Well,
so it just has to, if you're buying with any type of uncertainty, you just have to get a lower price. And
yeah,
that hasn't come through on the multifamily for most of it. Our last deal that we closed was at the end of 2022, and that was in Dallas. And we got a deal there, and it was about 10 or 12% off of what it was sold for a year before. So when you're getting that kind of discount on it, that's something where you're like, okay, this is a much safer setup here. This is, you're really alleviating risk and taking away some of that downside. That's one of the big things. If I'm getting stuff like that, but then see other stuff, and I see stuff coming across, and I'm not buying stuff in pre 1980 or something like that. I did that
yeah.
for many years. As the property gets older, becomes harder to collect rents. It's just how it is.
Listen, you're
Yeah.
talking to me. I still do it. My fund,
Yeah.
like we are buying. I mean, we don't buy all C properties, but like there's some. Just an example, we bought a 16 unit that came out of nowhere, and it was a dog of a property. But if there's any property that made me realize I need to change a little bit of the box, it was that one, just because of things behind the walls and tenant eviction issues and some drug stuff. That's why we bought the property, because it was like it was the eyesore of the whole entire neighborhood. We're like, we could clean that thing up. But yeah, you're nailing it. It's good for some people to hear this also, because if you are waiting and you're watching and you're building your investor base and being active on social media, you're going to have to know all these things, and you're going to have to pounce on it like you did, like we did.
Yeah, let me just say one thing too about the C class. I don't want to like beat C class down, but C class is just something for me when I'm taking money from investors, it wouldn't be something that I would put their investor money into.
Sure.
If I was doing a JV with like three other people, other professionals that had done this before and we were doing it together, that's fine because everybody's equal owner. Everybody has access to what's going on. They know exactly 100% of the risks they're getting into. They understand that cash flow might not be coming every month, every
Right.
quarter. It's much different when you're dealing with a passive investor that's they're all in stocks and bonds and getting dividends coming out every quarter, and it's much different relationship.
To finish that story, that 16 unit, 1 year and 1 day after we sold it, and we made like $600,000. So,
Wow.
like, yeah, we bought a dog, we sold it as a beautiful asset. But yeah, the more and more you see supply issues and this and labor and all this stuff, you got to buy cleaner, better stuff. It's just hard to find. So we're running into that. What about the future? Where do you see the next few months? Everyone's worried about rates. Yesterday we just had the Fed. I think they kept everything the same, right?
Yeah, we're keeping the window open. The window
Yes,
open.
the window
So,
open.
what does that mean? Yeah, I don't know.
Well, tell me. So, what do you see for the next few months? It's an election year. How are you going to get through the next year?
If we're anything that we're purchasing, obviously we're going to make sure that it's rate adjusted. We're making sure so the big thing is we have interest rates. A lot of people are focused on interest rates. That's a big thing, obviously. But it's also when we're looking at properties, we want to make sure that putting your debt service with it, but you're also your insurance and also taxes, which are other things that are going crazy. Coming down here from Florida, we just have massive issues with insurance. And so it's something that when we look down here, you're seeing, I think it's like home insurance down here, I was reading is like up since 2022, like 42%. It's insane.
Wow.
Our great state here, it's like I was reading an article and it was like we have the storms. Everybody wants to talk about storms and everything like that. And I'm like, I got it. I got the storms. But it's also we had a lot of inflation. So everything's becoming more expensive to fix. It's much like you said, labor. You're not paying $25 an hour for a handyman on your property anymore. You're paying
Yeah.
now 35, 40 plus, you know what I
50.
mean?
Yeah,
Yeah,
exactly.
exactly. Exactly. And
They
that's
know
the
they
thing.
could charge whatever they want right
Yeah.
now.
So you've got, that's a completely different thing. My dad used to pay $6 an hour for people in the mid 90s to be
We
handyman.
used to
So
pay you $5 an hour, right?
pay me $1 to count the rent. So it was just one thing that what would happen would be like, have that, but down here it's like 86 or 85% of like all lawsuits against insurance companies happen in Florida. Like we have
Wow.
just like lawyers gone crazy down here. That's why you're having people drop out. They're like, okay, we'd have to readjust for insurance. We have to like, double. And then now we have this thing where like people, whenever they want a new roof, they just like find an attorney and an adjuster
Yeah.
and they get it from us. So it's like it just doesn't make sense. And I can see a lot of so that's something that has to work down here. But anyway, when you're purchasing, we just have to make sure that you're having insurance, which I don't think it's done going up. So you really have to make sure that there's the days of 3% increases are done. You know what I mean?
Mm,
So now it's like if you see something that's like not higher single digits or like double digits, you're like, where how are you pricing up
yeah.
this insurance? Like so knowing that, Texas is one thing with taxes. So making sure when you're buying these properties that you know exactly. We have one property there and our tax bill is a little lower than what we expected it to be, but we're still worried. We're still putting money into reserve because we're like, it's going to go up. It's going to go up. You know what I mean? We're telling people, this isn't getting sent out. This is being held. I mean, that's just how it is in these places. Every place has like a unique problem and then throw interest rates on top of that. So just knowing when you're investing in properties, just make sure that you're pulling, back in the day, you'd pull the insurance that maybe came, the quote that came in your broker package. That's not like a thing anymore. You should never have done that, but now it's something that you really have to figure out exactly what you're getting for a
Yeah.
quote from the person that you've worked with before. You know what I mean? So you know that it's like
Yeah,
accurate.
you definitely can't go off that listing doc
No.
or anything. I mean,
Or what they're paying before because
that's what I was gonna say.
they might property might just like slip through because I've never
Yeah.
seen it before where I'm paying less than what they're paying really. You know what I mean? It's
No,
usually yeah.
no, never. And reassessments and
Well,
everything else that makes things difficult. It's funny, there's something going on because so many of my clients have gotten a call from the insurance companies saying, "Your roof is old, get it replaced or we're not giving you insurance."
mhm,
Just in the past 6 months, like, they're like, "Dude, what do I do here?" And you can't switch and whatnot. So there's definitely a lot of stuff going on. Don't have to talk about it, but there's wars and
no.
geopolitical unrest and election stuff. How about crystal ball? Do you see interest rates going down
Mhm.
sometime next year? Do you see it staying? Do you see it going up? What are your thoughts on this?
I think it'll stay where it is, possibly up if they, like I say before, they might go up another 25 basis points. I mean, I think it might stay similar to where we are now. And I think they might let it go a few months and see exactly where we stand. For commercial debt, for multifamily, it's something that is, we're going to see after those. Everybody got 2 year. If anybody got any interest caps, they were 2 years. We've gone through part of it from people that purchased in 2021, right? And like that's being worked out now. You know what I mean? Where those
Right.
2 years are coming
Yeah.
up. And now we're going to see what people that purchased at the beginning of 2022 or at the end of 2021, what's happening with that.
Yeah.
Because I mean, what were we mid 2022 when rates really started going up, something like this. So it's something that's when those come up because no one got 3 years. Everybody got 2 years because three
Yeah.
years was like twice as much, right? Which is insane when you talk about how much they are now compared to then. But we'll just see. I mean, that's the whole thing. And I think that you're going to have better properties are going to have more workouts. I don't think people that are thinking, oh, everything's going to fall out. I don't know. I mean, if you're buying better property, these are better properties. They're operating correctly. They're just having a little issue. These banks might just what they did with residential homes back in like 2010, 2009. And I remember I had contractors that worked for me and they would show me their paperwork and they weren't paying their mortgage or something for some reason. And then they would show me a thing and it'd say, oh, we're just going to change your mortgage sign here. We're changing your mortgage to 40 years from now, blah, blah, blah. And they ain't staying there for 40 years. It was
Right.
just something that was just kicking the can.
Yeah.
So I wouldn't doubt it, and it's a lot less expensive to do that than foreclose, especially on like smaller properties. So instead of having all this bad debt, now you just turned it to good debt again because you had the person, re-agree, they're up on it again. I don't know. I mean, I think you're gonna have these syndicators. These syndicators, most syndicators aren't in for long term. They're looking just to obviously make a profit. So it's something that if they can speak to the lender and say, if they can get that 24 or 36 months added on, whatever it is, work out something somewhere, tack it onto the back end. Who knows how they do it? I think you're gonna have a workout. I think on your less than ideal properties, right? So like lower C properties, tougher areas, those might just go back. You know what I
Yeah.
mean?
Yeah, it's very, very accurate that you mentioned that. Also, there was an article about all of these 5-year fixed and all these other folks that are about to lose their rates and they're just going to have to dump some of them, right? We're going to have some issues. There's some pain in the market. There's some pain for American employers and employees and all this fun stuff. We're coming to the end. What do you tell somebody? Because I have listeners who have just not pulled the trigger and every year they kick themselves. I should have done it last year. I should have done it 6 months ago. And I'm like, you should still do it now and find the right
Yeah.
asset. How do you motivate people today?
I think just showing them, where we've been and see it over a longer trajectory. I mean, everybody's gotten really used to selling these assets in 3 years and flipping and all this money and bringing back and 2xing their money and all this crazy stuff in 3 years, which doesn't happen and shouldn't really happen. But it's something that because when we'd start syndicating it was 5 to 7 years, and that's what we've been telling. I tell every investor that it's 5 to 7 years, and most investors don't care if they're getting some sort of distribution. But I think if you're a little bit worried about it, invest into a deal that has debt that's more fixed on it. Buy deals that are less heavy renovation, more light renovation, right? These type of ways you can really, if you're getting longer term debt, if the renovation's not that large, if you're buying in one of these areas that's actually growing, because the growing market gives you a buffer. So if
Mhm.
you're buying in a market with consistent population, consistent job, all the stuff is consistent, maybe it goes down up. There's not people moving into that market. It's not going to dramatically increase those prices. Where if you're buying to a property where we look at it and it's 2 or 3% up, or we look over a 20-year period, we see population going up, we see jobs going up that are diversified. Then we also see on the way down, we see that we're having crime go down over that 20-year period. These are growing areas. They're
Yeah.
investing back into the education, healthcare, the whole community is being invested into. They're taking that money from these taxes and they're actually putting in there. They're not paying off some bad debt somewhere, just something like this. So these are growing areas, and these are places that when rent increases, like when we're looking over our portfolio, no, our rents aren't going down. I read everything that's going on. Our rents aren't going down. Maybe I'm not putting my rents as high as they should be, but we're trying to avoid right now. We're trying to keep people in units
Yeah.
paying. This is
Vacancy.
where yes, we're minimizing vacancies, keeping collections high. That's like number one. When a vacancy going here or there, yes, that's when we'll renovate it. But maybe we're supposed to do 4 per month, and maybe we're doing 1. You know what I mean?
Yeah.
Just to
That's
see what the appetite is as you put them out, and that's a safe way of doing it. So if you're working with an operator that has a lot of experience, that's done this before, and you got, longer term debt, and then you also know that it's not that much. We're not going in there and moving walls. We're not going in there and like doing every roof and everything's going over and rebuilding a pool and a whole clubhouse. And, you're going in there and you're really, doing over little kitchens here, there, and there. and you're adding in, your rents. If you look, you see your comparable rents. So you can just pull up on Zillow too. So they give you the property address, the operator, you can pull it up and look at your own rents, and then just go and do your own research and just look at square footage, look at when it was built. Very simple. I mean, it's not a very complicated business. When you look at the underwriting, it's crazy. But if you just look at like basic stuff, people pay rent, where would you want to live? And then where else would I want to live? If I want to live in this neighborhood, am I going to live here, or am I going to live to a place that was just built 20 years newer across the street that now this guy tells me he's going to get the same rents for? It's just never going to happen. So basic common sense like that when you're looking, I mean, that's going to alleviate a lot of risks when you don't have to get into all the macroeconomics of what's going on.
That's great. That is a nice way to taper it down. And you're right, real estate is not that complicated until you start looking at the crazy Excel sheets and all that fun stuff. How does somebody invest with you, in you, communicate with you?
Yeah, if you're interested in learning more about what we do, my company is Harborside Partners. So if you go to harborsidepartners.com, we have a lot of information on there. I have a twice weekly podcast, one where I do interview based like this. And then I also do a Saturday one, which is called Strategy Saturday, which is just as a sound. I go over one strategy or go for some type of real estate investing thing that we're working on or feedback on the market. And then we have a free book on passively investing in real estate. So if you're interested, you can sign up for all that free information right there at harborsidepartners.com.
Great work. Great work. I got to give you my stamp of approval. I like strong fiduciaries, and you can just feel that you are one, you know your stuff. So congratulations to you. I wish you the best. Thanks for coming on.
Thank you so much for having me on.
For sure. It's Tejas Gosai. We just had Charles. Check out the website, Harborside Partners. Everything is in the show notes, and we're on iTunes, Spotify, Stitcher. Check out our website, rei.mba. Cheers. Thanks again, Charles.